Do you think home prices are falling in the Grand Rapids area? Well, watch this video and let's find out. Welcome to the Grand Rapids, Michigan, Kent County residential real estate market update with data through November 2022. My name is Rodney Constable. I'm a realtor with 616 Realty in Grand Rapids, Michigan. Year over year, home prices are up, guys, up 13.3% in the Grand Rapids area, with the average home selling for $346,981. 1 year ago, the average home was selling for $308,609. For years, I've heard people saying things like home prices can't continue to go up. Well, when I hear things like that, I think about the input costs to building a home. And some of the major input costs to building a home are land, labor, materials, and regulatory costs. So if somebody thinks that home prices cannot continue to rise in the future, what they're basically saying is that land is going to get cheaper and more plentiful. Labor is going to get cheaper and more plentiful. Materials are going to get cheaper and more plentiful. And the government's going to make regulatory costs of building a house cheaper and easier. And guys, when we just think about these four input costs, land, labor, materials, and regulatory costs, do we really think that any of these input costs to building a home are going to fall in the future? I doubt it. So if land, labor, materials, and regulatory costs are going to continue to go up, then home prices probably will continue to rise in the future as well. The average home is selling after being on the market for just 19 days. When we compare that to the inventory of unsold homes, we can see that those homes have been on the market for an average of 76 days. What these two data points tell us is that if a home is properly priced, it will sell in a relatively short period of time, right now in just under 3 weeks. However, if a home is not properly priced for its location, condition, and amenities, that home will stay on the market for an extended period of time, right now about 2.5 months. Next, let's take a look at year-to-date new listings. And again, we're looking at the same period 1 year ago. So we're looking at the first 11 months of 2022 versus the first 11 months of 2021. And in this category, we are down 4.83%. So again, we just looked at the fact that home prices are still rising, but the number of listings, right, the number of available properties for people to look at, right, buyers to look at and possibly buy are down 4.83% year over year. Now let's take a look at this in a numerical format. So for 2022, for the first 11 months of the year, there were 9,128 new listings in the entire county of Kent County. We compare that to 9,591 listings for the first 11 months of 2021. So we can see here that we're down 463 listings or 4.83% versus where we were 1 year ago. Now, when we go down to the bottom of the chart here and compare where we're at now, for the first 11 months of 2022 versus 2016, we can see that in 2016, for the first 11 months, there were 11,531 new listings that had come to market. So where we're at right now at 9128 is 2,403 listings fewer, or 20.84%, almost 21% fewer listings for people to choose from for the first 11 months of 2022 versus where we were in 2016. All right. So, and if you look at the trend, right, and I like to look at longer run data so we can really see what the trends are, guys. This is where the, where the juice is, so to speak. And so if we start at the bottom of the chart and just look our way up, we can see that we dropped off in 2017 to just over 11,000. There was a similar number in 2018. It ticked up a little bit in 2019, but then you can see in 2020, with, of course, COVID, we dropped down to 10,152 listings for the first 11 months of the year. And then in 2021, it dropped off. And then, of course, in 2022, it has dropped off again. All right. So there's fewer and fewer homes. This is the trend over the last 7 years, right? We're looking at 7 years of data here. So this is the trend. We're seeing fewer and fewer homes being listed. And I'm going to throw a term here. It's called golden handcuffs, right? And I think that this is going to be a problem going forward. In that, for those of us in the real estate industry, but also for anybody that is a buyer, and what this means, these golden handcuffs, what this means is that there's a lot of people out there that have refinanced when interest rates were extremely low, and they've got, under 4% or even under a 3% 30-year fixed rate mortgage. And a lot of those people, even if they wanted to move, even if they found a house or a neighborhood they liked a little bit better than the one they're in right now, with mortgage rates higher right now than they were, say, a year ago, for especially like a fixed rate mortgage. Now they are coming down, right? But the reality is, guys, I don't think we're, probably in our lifetime, we're never going to see, would be my guess. We're never going to see, a 3%, or it's probably going to be pretty tough to even get a 4% 30-year fixed rate mortgage. Okay. So if anybody out there is watching this and you're waiting waiting till mortgage rates come down to under 4% to buy a house, good luck, because in the meantime, housing prices are going to continue to rise over time. And you saw, in this video, you've already seen land, labor, materials, regulatory costs. Those things over time are probably going to continue to go up. Demand for housing will continue to go up. Fewer and fewer. I mean, we've got a situation here, guys, where since the housing crisis, if you will, back 2007 through 09, I know I'm throwing a lot at you guys, but stay with this because this is super important. Builders across the nation have underbuilt homes. Okay, so there's, I've seen data anywhere from 800,000 to over 3 million too few homes in the United States. All right, so we've underbuilt homes over the last 12 years or so, for many reasons. Builders just weren't not willing to speculate and build any more homes than absolutely necessary, and so this undersupply of homes is contributing to, is one of the major issues, right? Plus land, labor, materials, regulatory costs. I mean, all of this is coming together to continue to have upward pressure on home prices. All right, but with these golden handcuffs, if you will, right, from existing homeowners, we're probably going to see fewer and fewer existing homes being listed for quite a while, as those people that have refinanced over the last few years and have super low interest rates, fixed 15, 30-year mortgages, 15-year or 30-year mortgages, they're going to be very, very hesitant about selling their current home and going out and getting a new mortgage unless they can pay cash for the next property. They're going to be very hesitant about putting their home on the market because they just mentally will not be able to get over getting rid of a 3% 30-year fixed and going out and getting a 5.5% or 6%. All right. So if somebody, death, divorce, expansion of a family, moving for a job, those reasons, maybe people, if they have to move for whatever reason like that, those people obviously will put their homes on the market. But those people that are just aspirational in their buying, where in the past they would have put their home on the market, they're probably going to be very reluctant to now list that home. So, this issue here, guys, this is going to continue to be a problem going forward, where we have fewer and fewer listings available. Okay, so just understand that this trend is probably going to be in place now for another reason, for the foreseeable future. Next, let's take a look at year-to-date closed transactions versus the same period 1 year ago. So we just looked at the listings. Now let's take a look at the actual closed properties. And what we can see is year over year, again, first 11 months of this year versus the first 11 months of 2021, we can see we're down 11.80%. Let's take a look at this in a numerical format. And what we can see is that for the first 11 months of calendar year 2022, looking at the entire county of Kent County, which, of course, that pretty much encompasses all of Grand Rapids, right? We're looking at 7,601 closed transactions versus 8618 last year. That means we closed 1,017 fewer properties for the first 11 months of this year versus where we were last year. That's where the 11.80% comes in. When we compare this to what we did in 2016, we can see that we're down 1,675 fewer closed transactions this year than what we saw 7 years ago, and that's an 18.06% differential. And of course, the trend, right, starting at the bottom of the chart, work our way up, we can see that we dropped off from 9276 in 2016, and then in 2017 it dropped off to 8700, and then 2018, 2019, and 2020 were pretty equivalent there, kind of in that 8500 range, and so not a huge difference between 2018, 2019, and 2020 as far as the production, right, the amount of homes that were actually closed. And that's interesting, right, because 2020 obviously we have had COVID, but and then we ticked up a little bit last year. In 2021 we closed 8,618 homes for the first 11 months of the year, but look at what has happened here this year. And again, these trends, right, we're looking at the fewest amount of homes over the last 7 years. This is how far back I have this data available to me. So we have 7 years of data here, right, pretty good length of time, and we can clearly see that we're closing fewer and fewer homes year over year, and we just saw that we've had fewer and fewer listings, and there's many reasons why we're probably going to see fewer, even fewer listings for at least for the foreseeable future because of those golden handcuffs, those really low mortgage rates that existing homeowners have, those people that still have a mortgage on their property. They're going to be very hesitant, even if they want to move. They're going to have either a financial or a mental struggle with getting over having to refinance a newer home or a different home at a higher mortgage rate. Now, for those of you that are first-time home buyers, guys, even the mortgage rates we have now, right, are and check with your lender. But the mortgage rates we have now from a historical perspective are not high, okay? They're about average, for, say, the last 20 years. But check with your mortgage lender, check with your bank, your mortgage company, and they will, look at that data for you and tell you what you can qualify for as far as, say, a mortgage and give you the options. But, that we had historically low rates, unsustainably low rates for a period of time here for many reasons. But again, this is why I'm saying it's unlikely that we're going to see those super low interest rates again anytime soon. And from an economical standpoint, we really don't want to, all right? And that's a conversation for another story, for another time. If you want to talk more about that, give me a call, and we can talk personally about that. But just understand here, guys, and from an industry standpoint, all right? Again, those of you that are thinking that you can get into real estate and make easy money, nothing could be further from the truth, guys, okay? I mean, look at the trend here. There's fewer and fewer properties to sell. There's fewer and fewer transactions being done. So this is where we're seeing people say, well, the real estate market's down. Well, yeah, it from the industry standpoint, right? There's fewer transactions being done. There's fewer commissions being paid. There's fewer, there's less title work. There's less inspections. It's clear, right? It's right here. But that doesn't mean that home prices are falling, okay? Now, I want to be very clear. It's very possible that from a global standpoint, we're going to be in a recession in 2023. So I do not want to ignore that. And for those of you that don't know me all that well, I have an extensive financial services background going clear back to 1987, over and above being in real estate. Okay, so I come at this and probably think about this a little differently than a lot of realtors. And my point is that. Is it possible that home prices could fall in the Grand Rapids area? Absolutely. Are you going to hear about, and have you already heard about home prices falling in other areas of the United States? Absolutely, especially those areas, the coastal areas and the the multi-million-dollar properties, on the coast, Manhattan and out in LA. Sure, those types of properties will come down and and sell at a lower price than maybe they sold for a year or two ago. But in an area like Grand Rapids, that still from a national standpoint has very low home prices, okay, even around that 350 mark, guys, that is a very low number compared to most other areas, and especially compared to the average area in the United States. All right, so on a relative basis, homes are still relatively inexpensive here, and the cost of living is going to be much cheaper here for a lot of people than elsewhere. And for that reason, I'm getting people that are watching these videos and calling me from Scottsdale, from Chicago, and and they're calling me and talking to me about moving to Grand Rapids. And if you're a cash buyer, especially if you're a cash buyer, or you're moving from a more expensive area of the United States to an area like Grand Rapids, call me, let me help you, okay? Because your money will go a whole lot farther here than it will in many other areas of the United States, all right? So from an industry standpoint, yes, this is challenging the industry. But again, those of you that are homeowners or looking to buy, just understand, yes, we might see, a recession next year, but that does not mean necessarily that home prices are going to fall, or even if they do flatten off and come down a little bit, it's not likely that they're going to come down a lot here in Grand Rapids for all the reasons we've discussed. Plus, we're going to take a look at inventory here in a minute or two, and we'll talk more about that because, over and above everything else we've already talked about, land, labor, materials, regulatory costs, the underbuilding of homes across the nation, we're just not, we're not seeing entry-level properties being built because of land, labor, materials, regulatory costs. It's just too expensive for, builders can't make a profit, right, by building entry-level property. So guys, it's higher up the food chain, they can build a home that's above average price on, say, a larger lot, with its own septic and well and all that, and make a price, and make a profit, right, the builders. So that's where we're probably going to, for the most part, that's where we're going to continue to see the new homes, right, are either going to be a little higher up the food chain. They're probably not going to be entry-level properties because it's just too expensive for the builders to build these properties and make a profit, okay? All right, so now let's take a look at the average months of inventory in Kent County. Now, here I have more data available to me, so I have a whole decade, 10 years of data. So what we can see is in 2022, so far, for the first 11 months of the year, we've been averaging 0.8 months of inventory. Now, that's about 24 plus or minus days. Now, what this means is that if no new homes came to market in the entire county of Kent County, based on our current sell rate, we would be completely sold out of homes in about 24 days. Okay. Now, we are up a little bit compared to where we were last year at 0.6 months of inventory. That was about 18 plus or minus days, right, depending on the month, right? February, shorter month, and some months have 30, 31 days. So that's why it's 18, plus or minus last year, 24 plus or minus this year. So it's going up. But let's scroll down, and we can see in 2014 here that at 2.3 months of inventory, that was the highest on an annual basis. That was the highest average months of inventory we've seen in a decade, guys, and 2.3 months of inventory, as you'll see over the next couple minutes. 2.3 months of inventory is extremely low inventory, and we're running a third of that right now. So why does inventory matter? Well, as we can see here, if you have between 1 and 2 months of inventory, you probably are going to experience double-digit price appreciation on homes. And that is exactly what we have seen for many years here in the Grand Rapids area. If you're running between 3 and 4 months of inventory, you would generally experience single-digit price appreciation. If the inventory built to where you had between 5 and 6 months of inventory, this is more of a normal, balanced, or neutral market where you might experience some price appreciation, but it would more than likely be in the low single digits. And if you're under 5 to 6 months of inventory, this is considered a seller's market. And that's exactly what we have seen for many years here in Grand Rapids. If you're over 6 months of inventory, this is considered a buyer's market. And if your inventory built to between 7 and 8 months, that's when you would most likely experience single-digit price depreciation. And then if the inventory built to 9 months plus, that's when you would likely see double-digit price depreciation. So 7 to 8 months of inventory, single-digit price depreciation, 9 months plus, that's when we start to get into double-digit price depreciation. Are you looking for a realtor you can trust? If so, look no further. When you are ready, let me put my decades of sales and business experience to work for for you. Call me directly at 616-258-4782 to discuss your situation or to just talk about real estate. I look forward to helping you succeed. Once again, that phone number is 616-258-4782.